Well, good morning. How is everybody today? My name's
Morning.
Mark Heil, and as Marty said, we're going to be talking about alpha strategies. So this is going to be a very exciting conversation. We have a great panel here. I believe two are online. So we have Tyson, Halsey. Marty, are we getting Tyson up? All right, not fast enough. Come on, let's get on it. We also have Rick Stone, as Marty just introduced a minute ago. But up here
Good
with me
morning.
on stage, we have Wendy Diamond, who represents various investors and various investor groups. You don't? You're a family. Oh, okay. Well, Marty's description here is a little bit off. Okay, he just called me like 3 minutes ago. I tried calling him back, but I couldn't reach him. So he may have something going on. I don't know. And of course, we have Andy Fisch. He's with Five Oceans, not the Seven Seas, the Five Oceans. So be very clear on that. So we'll be talking about alpha strategies and probing where you can find in today's markets. You heard the economy is something that's a little unsure because of geopolitical concerns and because of U.S. debt and other things that are taking place. There are several scenarios that can work out, some positive and some negative. So we'll see what happens. So in this environment, we're going to be talking about where you find alpha. And that guy is always hiding somewhere, but he's always available. And the trick is knowing where to find them, where to see them, where to get them. And that's what we're going to be talking about today. My name is Mark Heil. I'm with a group called Pickwick Capital Partners. We're an investment bank as well as a capital raising firm. We've been at this since 2008. We have 140 people on our platform. We do all sorts of deals in all different sectors. So happy to lead this conversation. Where's Chip? I don't want you to miss your favorite part. You're not going to miss it? Okay. You want to say it? You could. Okay. His favorite part is the disclaimer. And that is this discussion is for educational purposes, not to be considered tax, legal, or financial advice. To the extent we express opinions up here, there are our opinions alone and not necessarily those of our organizations we represent. So with that, let's get our panel introduced and get this conversation started. And Wendy, I'm going to start with you. You're going to just introduce yourself and say hi.
Good morning. Woohoo! I'm Wendy. I'm from Ohio, where we're a family office, third generation. I'm not officially a investor, but I'm part of the committee that actually, introduces different things. So my background, I really started getting into investing in 2014. He kept saying him alpha, the whole thing. It's really what I really got started in investing was in 2013 when I ended up in Honduras on vacation, not realizing it was the murder capital of the world. And I ended up volunteering for an organization as microloans to poor women. And I learned all the statistics about women in business. And I learned at that time 1% of venture dollars went toward women founders. About millions of microloans around the world, all the data showed that the women were paying back these microloans at a 98% rate, men in the 60% range. And literally I learned when women are empowered in business, they give 90% of their money goes to educate their children, provide for their families, uplift the entire communities. When women are empowered in business, they have self-confidence, they have dignity, they don't allow human rights violations. So that was when I created an official day in the world on November 19th. I hope everyone, celebrates Women's Entrepreneurship Day that's recognized by U.S. Congress, the King of Qatar, President of Mexico, around the world. And what we do is we bring governments, business leaders, civil society, entrepreneurs, investors to collaborate to find solutions to economically empower women to start their entrepreneurial journeys from a ground up approach. And that was where, because I never really care. My whole life has been about impact. I've been helping homeless people, homeless animals, impoverished women to start their entrepreneurial journeys my whole entire career. But in 2014, we launched at the United Nations, and I was bringing a lot of people I knew and learning about investing. and investing in women founders and, bringing that to the forefront of media as well, because nobody at that time was talking about women entrepreneurs or women in business, very little. And there was very few companies recognizing women in their companies, et cetera. And then that's when I ended up learning about Bitcoin in 2014 from a goat farmer in Botswana that led me on this whole journey of where we are today. And I guess that I'll stop there, and you'll probably ask me other stuff later.
Oh, you can count on it. And if I don't, Andy will, I promise you. So Andy, you're here in person. You're up next.
Yeah. So I'm not going to talk about mission because this is an alpha panel. Nothing wrong with that, but we're opportunistic. We've been in impact investing, and I'm the original impact investor. It's my 41st year as a professional investor, and before that, I was an econ major that studied. My honors project was the global depletion of energy reserves, and I went to college to be a bio major, to be a marine biologist. So the world's come full circle for me all the way around. In between, though, I spent 20 years in a group of multifamily offices, captive capital. We didn't raise money. We just did things. I ran a hedge fund, several venture funds. And then I went to the dark side. I spent 13 years at State Street. I ran the global fund of hedge funds for a long time. We were pretty successful, and we didn't lose any money in 08. And we made some money here and there too. So that worked out well until cycles caught up and went back to family office investing 9 years ago. And we only do special purpose vehicles that are co-invests. So everything is an isolated, specific, could be thematic, could be not. Generally, so an old State Street colleague at JP Morgan, he said, well, what are you doing these days? I said, anything that JP Morgan sells, we don't do it. If you can go buy it, we don't do it. So, all those years ago when we were running hedge funds and venture funds, alternatives were not widely available. So I'm dating myself, but it's important to this conversation because the last conversation I want to pick up from cycles and alpha related to cycles is what I'll start with. But let's move on.
That'll be great. Hey Marty, are we good to go? Is Rick ready?
Rick is here. I'm ready.
Okay, Rick. Rick, you speak so we can see you?
Yes. Can you hear me?
We can hear you. Rick, I got a question for you. What's
Yes,
the
sir.
most frightening thing you can say to a broker?
What's the most what?
Frightening thing you can say to a broker?
There's going to be a flat market for the next 10 years, and it's going to be hard to charge a 2% wrap fee.
Oh, that's a good one, but I think I'm a litigator and I'm here to invest. Rick, why don't you introduce yourself?
So I'm Rick Stone. I have my own family office. I'm from Palm Beach, Florida. And I also run a group that Marty introduced called Palm Beach Investment Research Group. Palm Beach Investment Research Group is a group of 35 family offices mostly from South Florida who meet twice a month, except in the summer, to vet investment ideas, anything from venture capital, private equity, hedge funds, co-invest, one-off deals, a lot of private lending, a lot of multifamily, residential. But what is interesting to the group, we bring to the group, and then each individual member makes their own investment decision, but we share the due diligence process. We've been in business for 15 years. We're structured as a not-for-profit, so no one has an incentive to bring any manager to the group because they're not getting paid. In that time, we've seen over 800 managers, all in the alternative space.
Fantastic. Thank you, Rick. That was terrific. Tyson, are you there? Do we have Tyson? Okay. All right. That's fine. He called me, so I'm assuming something's up. But with that, let's get started. If we need a pinch hitter, we'll just reach out in the audience and grab somebody. But Andy, I actually want to start with you because during our prep call, you raised a certain topic around alpha. And usually what we mean by alpha is, overperformance against the benchmark or outperforming the risk of your expected returns based on risk, something along those lines.
So what I was leading up to was the last conversation He was talking about late cycle. He was talking in economic and macro terms. So I can't remember how many years ago I gave a keynote. It was called late cycle investing. I can't remember how many years ago. That's the last time we had a cycle, whenever that was. So anyway, uh, that parallel is true now for the investment universe. If you go back 5 years, it's not the case, and I'll explain what I'm talking about. So alpha could be you have a portfolio of stocks. Make it simple. Could be bonds, could be venture capital, could be anything. Okay. And as Mark just pointed out, there's benchmarks, a lot of passive investing, and you add value to that. But you're getting beta risk along with your alpha. It's okay. Like I said, 5 years ago, that was dreamland. Okay, today, not so much the case. Today, it's split between, that could be the case, although we just heard an argument that, well, I'll just summarize in my own words that most assets are overvalued. Okay, you can take it or leave it, and I don't want to get in a long conversation because it's the wrong panel for that. But the point is there are cycles, and cycles matter. And so, in my view, we've come to the end of a venture capital cycle. There's no venture capitalist that thinks they're cycles. I did my first VC deal in 1994, so I've actually seen some cycles. And that's true for a lot of things. So what we have now is, it's not a 2008 where the whole world's falling apart. Could happen, hell, we've got wars and all kinds of stuff. Who knows? I don't have a crystal ball, but that's not the point. I'm talking about what we're actually seeing. And we actually seeing cracks. You're seeing things that there are little bubbles bursting. There are companies that can't get refinanced. 5 years ago, everything got refinanced. I think the woman who runs Trust Company in the West, huge asset manager, said their biggest area right now is rescue finance. Well, when I left the institution in 2017, there was nothing to rescue because everything was perfect. So here, alpha could be going in, and I'll make something up because it applies to a lot of things. You're going in and you're buying some defaulted debt, and you restructure the debt, and you recapitalize the company, and you create something that wasn't there before. You had something going to zero, and now you've got something of value. That's alpha. Okay. The last piece of alpha, which people misconstrue, is take a market neutral fund. Market neutral on anything. Okay. So the market neutral fund, in theory, has no beta. Well, it has betas, but we won't get into the quant quake of 2007. That's a part of the cycle story. I might reuse it. My point is that ostensibly, all the returns are alpha because you're long something and you're short something of relatively, fungible risk. So that's where I want to go with this, is that you've got alpha in terms of what Mark defined, which is beta, but with value add. You have alpha where there's things going wrong, commercial debt, restructuring, empty buildings on Park Avenue 5 years ago, they're all full now, et cetera, et cetera, et cetera. So this is a world where those opportunities are happening, and I'll leave it with a statistic. 85% of VC-backed companies have less than 1 year of cash.
Wow.
So is it more work to find the alpha today than in which, the last 10 years that we just came off of with low inflation rates and things of that nature?
Yeah. So
What's involved?
So from two simple standpoints, if you're looking for alpha on top of beta, okay, your beta risk could swamp whatever alpha you're generating. You might lose less than an index or whatever you want to call it, but you're taking on that risk. The other side, of course, is risks. You're buying some bond at 20 cents on the dollar. It can go to zero. Of course it can. But that is harder work, because the reason that opportunity is there is somebody with experience and knowledge and resources has to go in and really get their hands dirty. And a lot of them are going to zero. So you have to filter the ball out.
So Rick and Wendy, I want to follow up with Andy was just speaking about with you. And as I'm family office, managing your portfolios. How do you think about managing the totality of that portfolio? You know, your public versus non-public, your liquid versus illiquid, your, you know, anything along those lines that you have some thoughts on?
Well, so when I started actually paying attention and kind of hearing about this, and first of all, alpha, there's been no better alpha in the entire history of the world that other than Bitcoin. So literally, when you look at the charts, Bitcoin has done, and MicroStrategy. I mean, how many people in this room have bought Bitcoin? Wow. Okay. I mean, I have to. It's funny. Okay. So how many people own MicroStrategy? Wow. Okay. So you know, I go back again. I don't. You know, I have a super high EQ, low IQ. So if I'm going to get involved and invest and you know get behind something, is because I really understand it and I really care about it and I've seen the impact that it has. And going back to 2014, I learned about Bitcoin from a goat farmer in Botswana. And it was because of my foundation. We partnered with the State Department. And I saw this woman who literally lived in a one-room hut create the Satoshi Center, teaching all these farmers about Bitcoin. And I had no understanding. I have no financial background. I have no technical background. But what I realized is I really went down the rabbit hole of understanding the founders. Because I believe, like, if you're going to invest in something, you should really know it and you should really care about it. Because in this day and age, if you're just going to invest to make money, you're going to wake up one day and realize, what did I spend my whole life doing, right? And so my whole thing was, when I met that, I started going down the rabbit hole and I realized, wow, the founders of Bitcoin were the most high integrity founders in the entire world. And everyone's like, and the reason why is because they didn't care about like the three, well, let's say quote unquote evils. They didn't care about fame, money, or power. They created a fake name, so they have no fame. They created a fake name, they have no power. And they never sold or transferred a Bitcoin. Why? Because it's on the blockchain and it's traceable, transparent, and immutable. So we know exactly the numbers. And that brought me into that world. You know, I got involved in the whole community in New York. At that time, our family office was like, you know, my family would like, I mean, I will say, like in 2014, I asked for a lot of money and they only gave me 10% of what I wanted. I can tell you right now that has done better than any other investment we've ever done in our lifetime of, you know, investing. In 2016, we got into the, you know, the launch of Ethereum. And in 2016, we also started investing in more emerging managers, because at that time, we never invested in an emerging manager, ever. And that led us to investing in a lot of emerging managers in the AI space, a lot of emerging managers in the Web3 space. Those funds themselves, I would consider alpha, because those were very, you know, those were not, these are risks. And those ended up doing better than, you know, a lot of the other ones that, you know, we've been in. I won't say those, but whatever. I mean, because I don't, you know, I didn't make those decisions to go into the other ones. And so how I look at it today is, you know, one of the things that we should all think about is the millennials, Gen Z, alpha, they don't trust the governments, they don't trust the banks. So they've been brought up on their phones and they want traceability, they want transparency. There's a difference between crypto and Bitcoin. Crypto, you know, Bitcoin is the only decentralized financial instrument ever created in history. Literally, like there's like Bitcoin, Ethereum and everything else is centralized, right? And we're going into a world where another aspect we're investing is DPIN. How many people know what DPIN is? Woohoo! You go, Mark. All right, well, you're going to start hearing about it in the next 5 years, because DPIN is decentralized infrastructure. Our whole world now, think of supply chain, is all over the place, right? But when it becomes decentralized and when it becomes one place where you can see everything, you're going to see a lot of traceability and transparency, enable everyone to participate in that supply chain, right? And benefit from that supply chain. And so what we believe is, and then why I created my foundation to help women entrepreneurs, investing in women founders, investing in women funds. We've seen, as you see, when women are on the founding teams, companies are 63%, more profitable when you invest in women founders. There's all the stats, I could go through them. But my point being is, I don't come from his background at all, right? And what we're investing in, especially Bitcoin, is a lot different. It was never taught in schools, right? It was never taught in business school. This is
Didn't exist when I was in school.
right. Well, yeah, right. And so, so this defies everything, right? But I believe what we're going to see in the future, and you see if you follow it, just yesterday, basically Anthony Pompliano did a SPAC. I don't know if you saw that, but literally, yeah, which he raised $750 million to invest and create a Bitcoin treasury. Our family's been in MicroStrategy since the beginning, since they started in Bitcoin. I was on a call and I realized he was getting in. And so we are very strong on MicroStrategy. That has outperformed NVIDIA in the last 5 years, just to give it some context. And so, yeah. So that's pretty much, what we believe in. It's just, really being able to dedicate into emerging managers, disruptive technologies that are going to create a better world for everybody.
Fantastic. Rick, why don't you chime in and talk about your family office and how you value your portfolio?
Well, I think it's a tough issue for family offices allocation because most of the time we're investing in drawdown strategies. And you really don't have a good picture of when they're going to call the money. The J curve could be longer or shorter depending on lots of factors. We have a medical technology fund right now that's only drawn 10% of its money in 2 years. We had several distressed debt funds in the past few years that draw down no money. So it's a tougher thing than it appears to be. Obviously, we start with an allocation. We're mostly alts, almost entirely alts. So in our alt space, how much is going to be lending? How much is going to be multifamily real estate? How much is going to be venture, a small part right now? And how much is going to be unique strategies and co-invest? But it's very difficult to do because you're typically starting with a static pool of capital. We're not an institution like Harvard who's getting money every year from donations. We have a static pool of capital. We don't know when money's coming back from venture capital deals, a long time in the future, and when J curve is going to end and we're going to get returns, and when people are going to call money. So it's an extremely difficult calculus that I would say we didn't perceive as being as difficult when we started 15 years ago. This has caused a lot of members of my investment group, the 35 families, to look for shorter strategies, for trading strategies, for strategies that have more liquidity on a quarterly basis. It's a little bit chimerical. It's very hard to do because it's hard to value non-publicly traded assets on a quarterly basis, but that's become a bigger theme in the group lately.
Hey, Rick and Wendy, I just got a question from the audience asking, what are the sizes you like to invest? What are your check sizes? Yeah, you win, Rick. You were Rick. Rick, why don't you go first?
Typically 1 to 2 million per member in a private structure.
And do you usually roll up a few families when you go in?
No, we invest individually. Often we invest in the same thing, but it's all individual subscription agreements and investment decisions.
Understood. Thank you. Wendy.
Now, again, I don't want to say I don't work on I only have a little part of the, of allocation. So I don't want to say that what the other stuff that they are investing in. They're in every asset class. We're in 60 funds. So there's a lot, in that. So I would say the stuff that I've been involved with that I actually care about, 1 to 5 million in the funds. And then we also go into startups anywhere from 50 to 500,000.
So I was just going to ask, do you have a preference for either directs or do you prefer going through funds? And that's for all the panelists.
So we're always co-investors. So we could be we did a biotech venture fund. And so we built an SPV, we put half the money in the fund. We are not on the investment committee. Our only rule is we want all the information. The investment committee gets to make a decision. We give them our feedback, and then we can do with the 50% in our SPV. The other side would be that we did it with a shipping company. We turned the shipping company's balance sheet into a special purpose vehicle, and all the ships and the assets and the cash flow distribution was in an SPV vehicle. So that would be a direct, because one company, the other one's a fund. So we're opportunistic.
Yeah, agnostic as to the structure there. Got it.
Yeah, I mean, right now we're working with a fund, but we're not in the fund. We're doing something on the side.
Right, right. That in the nature of co-investment.
Exactly.
Got it. Wendy,
Wait, what was the question? What?
would you prefer directs or do
Oh,
you
yeah,
prefer going through funds?
I mean, so again, I'm not a full-time investor. I have a foundation. I help impoverished, disadvantaged women start their entrepreneurial journeys. That's my main love. And so it depends, so we're, when it comes to, our family office does not invest direct. If I decide that I want to go direct, that would be when we do it. And then we probably go into 2 new funds a year.
How many do you look at?
So I don't work on the real estate, but we're in a bunch of real estate funds and you know what I mean? So, yeah, mine are I'm emerging managers.
Gotcha. Rick?
Very rarely will we do a direct because it's a huge amount of work. You have to review legal documents. You have to review the underlying assets. So unless you're going to invest a substantial amount of money, the legal fees aren't worth it. And I'm a lawyer and I do that for a living. I have to hire an outside lawyer to do that. So almost all of our investments are either co-invest or with a manager.
Do either of any of you invest directly in?
Mike's off.
Hello?
That's it. Couldn't hear you.
Do any of you invest directly in transactions, anywhere from initially maybe 5 million to several hundred million and up?
Okay, so.
It's not a fund.
So if you're going to build an SPV, there's certain overhead and setup and it varies tremendously on the simplicity or lack of simplicity of what you're doing.
I know what an
So
SPV
that would
is.
be, call it 5 million before, otherwise the costs are going to overrun everything. But sometimes you want to start with a small amount and build, because that could be one situation. The other thing is we're always below the bottom of the middle market. And in the 20 years since I was first investing in family offices, then in the institutional world, the middle market went from here to here to here. So the bottom of the middle market is north of $100 million deal. So we wouldn't go into anything. It's part of a strategy. Wouldn't go into anything where we're so-called competing with any institutional sort of asset managers. That's the whole point of the whole thing.
Yeah, I'm not looking for an SPV. I'm looking to see whether or not you would invest in a holding company concept. The
So
business is already
we-
structured.
So we did a portfolio of specialty finance funds, sort of a holding company, more like a fund of funds.
We have the structure already. We're just looking for the capital.
Okay, so structure. The last thing we do is build a structure. You figure out the investment, you figure out the parameters, you figure out the deal with your co-invest, you figure out which families are in, which families are out, what their issues are, what their risk tolerance is. And then the last thing you do is you build a structure wherever offshore, onshore, feeders, whatever you need to do to suit that whole dynamic.
Okay.
Got it.
What else?
Marty.
I don't know if that answered
I
your
got it.
question, but.
I mean, a lot of the value is in the, yeah, a lot of the value is in the structuring when you do directs, right?
It's more like risk, because the value you've already figured out. You don't build a see, people do, you build a structure, you go out and raise money for it, right? Some venture fund, whatever, impact fund. We don't do that. First of all, we don't raise money. So if we raise money, it's because we've got some families and then we need more money, but we've already got the thing done. So the value is the investment that we've structured up front but not the structure itself it's more of a risk instrument than anything else, or tax instrument.
That's all right.
You're
We can get
asking-
them afterwards
we-
and ask them.
We do not have any holding companies where we have an SPV that owns company A, company B, company C. That's private equity, and it's not really one of our strategies.
But I did want to ask you and Rick, particularly since you gather up families and make investments into certain opportunities that are available to you, about how that process works.
The simple thing, which is true, I've always believed for anything you're investing in, whatever you're looking to invest in, look at a lot of things, filter them down, and be disciplined and invest in very few. We only do a few things a year.
Great. Rick, do you want to comment on that?
Yeah, I mean, we look at areas where we're interested in investing. Are we interested in lending now with rates not very high, but higher than they were? So can we achieve 10 to 12% in a relatively secure loan portfolio? So if we like that space, we'll bring 3 or 5 managers in that space who are not on investment bank or banking platforms. We'll evaluate them. We'll make a decision on which ones we like, and that could be different. Some people will like A and some people will like B, but we do pick spaces that we think are attractive in the current market. And then we bring a group of managers and people, inquire of them, do due diligence, and again, make their own investment decisions. We're only doing alts. We're not doing stocks and bonds. To the extent people in our group do stocks and bonds, they do that apart from our group. Our position is the markets will underperform for the foreseeable future, and alts will be the only place to get outperformance or alpha.
And currently, what are your where do your investors see the alpha right now? What are the pockets they're looking to invest in?
I mean, you first have to start with what are you outperforming to get your alpha. So we think we've had very good years in the stock market, largely driven by increase in the money supply, in our opinion. The United States has been an attractive place to invest for many, many reasons. American exceptionalism. Our multiples were almost double those in Europe and triple those in China. And slowly that is changing. The dollar is weakening, the euro is strengthening. That's less attractive for European investors here. Our valuations are seen as high in the rest of the world. Money may not transfer here as much. So we think that we'll have a more level stock market performance for the foreseeable future, and achieving 10 to 12% in either private lending, multifamily real estate, trading strategies, will be outperformance by a substantial amount.
A statement and a question, which was that for Andy, and maybe Rick can join in too. I think maybe you mentioned there's a whole thought of crowded trades, like in private equity and venture capital and things like that. So maybe you guys can expand on it, because maybe you're not looking for private equity style investments in funds right now because there's just so much out there and there's so much liquidity, right, in that, right? So that's one aspect. And then the second aspect is that we had Duke University emerging manager, endowment come in years ago after the 2008 crash, and they said, hey, we're just looking at things thematically. If we can do it cheaper, we're going to do it cheaper rather than invest in a hedge fund. And maybe you and Rick can talk about that too.
So, okay, there's 3 questions in there. So the simple thing was, in 2008, I was running a fund, and we had purposely built up cash reserves. So 2009, we were one of the few people that had cash to go out and do, let's call it creative things, when capital was dear. But I think what you were getting at the beginning, and I was talking about cycles and late cycle investing, is you had a decade where every venture deal got done at a higher valuation than before. And the problem with that is that you have these hockey stick projections. A few of them might work. Some of them go public regardless of whether they work. But most of them, you end up with entrepreneurs growing their company, and they're not as disciplined with cash burn as they would be if they weren't confident in their next round. I'm just using venture capital as an example. 0 rates. There's people out there with 2.5% mortgages. I don't know the older people in the room, but that's not normal. Okay? The guy there was talking about, everybody's talking about the Fed fund rate. Rates are normal. A 4.3% 10-year bond is normal. It's a normal thing. We've got a 2.5% inflation rate. It's normal. And a 7% mortgage rate. It's normal. 0% or negative rates in Germany is not normal. So that created distortions in the asset values. Because if your interest rate's zero, it's called earnings yield. You flip P upside down. What is the future value of earnings of a company discounted to the present? And as most of you learned in grammar school, can't divide by zero. So what happens is you get these very justified high valuations for stocks, and they're pumped by liquidity from the Fed. Then you get the real estate market going through the roof because you have a 2% mortgage. Well, all you're looking at is your total cost of ownership. So if the house is more expensive and the mortgage is cheap, fine, I can make those payments. But that's not normal, and it distorted the real estate market. Now, what happens at the end of cycles, everybody thinks of '08, okay? That's a systemic problem. I used to say when I spoke at a lot of conferences for a long time, and I'd say there's a once in 100-year event every 7 years. And that means there's a 20 once in 100-year events every century. They're just different. Savings and loan crisis, 87 crash, I was trading actually, .com boom bust, et cetera, et cetera, et cetera. Not just the 2008 GFC. So what's happening now is that you had this asset inflation for a very long time. And some of those assets can support the value. Like, for instance, residential real estate in New York City has never been this good. So, unless you were greedy, got short-term financing and your financing rate went through the roof, which did happen, by the way, to a few people, you're good. On the other hand, if you got an empty building, in New York City and all your tenants have gone virtual, you got a problem. So that's the late cycle investing is going to create holes. Our problem is having groups of family offices. We can't, and we have been in things in runoff, but we can't have a pool of cash because we let everything run off. And this is where Marty's third question was, that we have way too many people that have, aside from us, because we keep everything 5 years or less. It's one of our rules. So they've committed long-term commitments to VCs, long-term commitments to PE funds, long-term commitments to real estate funds, and now we added on long-term commitments to direct lending. I did direct lending for pensions in 2012. We put everything in runoff in 2019, and that's all gone. Now we're sort of going back to other cash generating. You had a question, sorry.
What's happening, what you're saying is that lower interest rates, the abnormal lower interest rates are making corporations look better than their capability is. And when those interest rates stabilize, as they did, the credibility of the institution or the company, rather than being highly profitable and highly valued, the valuation has to come down.
Simple answer. Okay, you can do all I said about the valuation math, take it, it's math. But I give you two real world, very simple examples. Rates went from zero, the Fed funds rate, risk-free rate, I don't think you can call it that anymore, but whatever, went from 0 to 5%. That in itself isn't a big deal. It did it in 9 months. That's the fastest Fed rate rise in history. And so what happened? Well, did you notice all those companies driving S&P 500? Apple, they're full of cash. They don't have a debt service. So they actually had a huge benefit, but they're in the minority. What also happened was high yield was about 5.5%. So those marginal companies, that's their cost of debt service. When they refied and began in the spring of 23, they refied at 8.5%. And that's why TCW is doing corporate rescue finance.
Perfect.
I agree with that.
Thank you. That was very insightful. Rick, we want to get your thoughts on this, so why don't you chime in?
I honestly forgot what the question was. I apologize.
How to trade private equity and private capital. Venture capital, apologies.
Okay, so private equity We're not interested in investing now. The deals have lasted much, much longer. There were supposed to be 10-year deals. They're now 13 to 15-year deals. There's not a viable exit strategy. The industry has a solution for this problem. I use that word euphemistically, which is called evergreen private equity. The industry realizes that you can have periods of time where you cannot sell venture companies. So they want to lock up money forever, literally forever, evergreen, and then give you chimerical quarterly liquidity, where they'll mark positions in a way that is beyond my capability, because I don't know how you mark private companies on a consistent, regular basis, and then allow you to get some liquidity on a quarterly basis. But they realize that the model is broken, that they can't lock up money for 15 years and expect people to invest in that strategy. So they've moved to evergreen. We have done some secondary fund investing and continuation fund investing, also a very crowded space, a huge amount of money chasing after deals. There are a lot of deals, more than you'd think. There are individuals selling, there are corporate selling, there are universities selling, all to get some more liquidity. But it is a crowded space. We have done some investing there. Our strategy is more to do shorter term investments with a lockup. We don't think that there's a way to avoid in private lending some lockup. The loans are not going to turn over in 2 or 3 years, and they're not going to sell the loan at a discount when they think that the loan's going to pay par or above in another 2 years. Managers have discretion with respect to that, and they often fall in love with their deals, especially the deals that haven't worked. So the length of the fund is a problem, but not a actionable problem in our opinion.
Great. Tyson, I want to welcome you to the conversation.
Sorry to get here late. I agree with Richard Stone. And
I actually wanted to take it a little bit different direction. If you would just do 1 minute on your background. And then Andy had made some comments earlier about, being end of cycle, and you need to think about what you're going to do next with your assets, and you constantly have to be rotating them. So I know you have a philosophy on that, and I'd like you to touch on that if you would.
sure, I think that the investment paradigms developed over the last 40 years started changing on 2020 when the 10-year treasury got down to 55 basis points or 50 basis points, down from about 16% in 1981. And those declining interest rates helped drive stocks, bonds, and real estate. And we've had fabulous returns there. And everybody's all in. Private equity, venture, all benefit from it. And I think that we have a much different interest rate environment, inflation environment. And so that leads to basically we want to rotate into new areas which we see doing well. And there's a lot of value that's been created in areas that fell out of favor. International, emerging markets. I think commodities, precious metals in particular, we're particularly keen on gold miners. Small cap value, all that stuff, I think you have to start looking at. And the way quantitative money is managed, momentum is always a big factor. But you look at a lot of the charts on a lot of these sectors, and they've had bear markets. And now they're starting to see money flow in. They're starting to move up, and they're cheap. And that's where people need to be investing. Perfect.
Wendy, I know you had a couple thoughts on tokenization and how that helps with liquidity issues in private companies. And why don't you speak to that issue?
Right. So kind of thinking about liquidity, we're at a liquidity fund. One of the things I think about the future is tokenization. Everybody, where it enables everyone to be able to, whether we're talking about real estate or et cetera, there's less companies going public now on the NASDAQ and New York Stock Exchange, right? And there's this $3 trillion market of crypto where you could literally create a token and enable liquidity immediately. And so I believe the future is going to be tokenization of everything. I believe that, people are more apt to want liquidity sooner than later. Like I personally, it's very hard for us to go into, you know, a 10-year fund where we're not going to get anywhere, you know, we're not going to be able to get out for 10 years because at the end of the day, that's a long time. And that's why really I believe in what the future is with blockchain and tokenization and liquidity. Mm-hmm.
NFTs are usually correlated to a specific item that makes them an exception, a mutually exclusive item.
Right.
How are you using the word NFT here in your comment? Because what you're applying it to is something on a broader scale, more than one item.
Okay.
Explain that.
So an NFT is a non-fungible token. And what I really want to kind of bring in a simple way for everyone to understand is the future is we want to know what we're eating. We want to know what this chair was made of. So we want traceability and transparency on everything. I don't even put anything on my face or like I don't even eat things unless I use an app to tell me what's in it. And if there's anything toxic in it, I say no, right? And I think this is the future of what we're seeing in millennials, Gen Z, Alpha, and people like me who's never lost their inner child. You know what I mean? I always want to learn. I always want to say why, how, where. And I think this is the future is holding provenance. NFTs hold the provenance of, you know, where was it made, who owned it, and that's all based on the blockchain. And so I think the future, what you're going to see, you know, as we heard of the, you know, the first thing was art, right? Where that was like, it went so high, blah, blah, blah. But it's still right now, what you're going to see is the use cases amongst everything. So whether it's real estate, whether it's, you know, companies, whatever it might be, I think that more people are going to start they are investing in it. I mean, this market is out, you know, you just saw, you know, you're seeing billions and billions of dollars in announcements every day of more Bitcoin treasuries, more investments in, you know, Solana protocol, et cetera, that you're going to see a lot more use cases for this and that you'll see this on a day-to-day. But I think right now, as you see JP Morgan just announced, right, that they're doing their own US coin. And so I think we're going to see this more.
Oh, I think so too. I mean, we had Pantera on a couple months ago on the panel, right, Marty? And they're speaking today. They're here. So you'll hear more about this a little bit later, so I won't take up too much time on that point. Marty, did you give me a time? 5, 10, 15? Perfect. Okay. But what I do want to go into with the, you know, the point about Pantera, it's not just the coins, right? There's a whole environment supporting that. And Andy, I can see you're nodding and
Yeah.
why don't you
So-
talk, and Rick, if you want to follow up, that'd be
So the
great.
first thing is, because I was the econ major, could write 100,000 lines of computer code, and I'm the original techie. So just to help use some words. So Bitcoin, Satoshi, is an algorithm. You can only make a fixed number of Bitcoins in the world, no matter what. Okay, that's what separates it from every other token on the planet. Okay, you've heard of crypto mining. I'm not going to get into the whole thing. It's a mathematical process, and as we get closer and closer to the physical limit of how many Bitcoins, it gets more difficult, and we're almost there. So just, you know, that was an explanation for some of the things that she was saying early on. Non-fungible token, let's go to the complete other side. Just take the words non-fungible and hold that for a second. So now what Wendy was just talking about is tokenization of real estate, tokenization of art. Those are asset-backed tokens. You tokenize art, there's actual physical art behind the token. And it's not non-fungible. If you wanted to destroy the token, you could sell the art and destroy and give and exchange the token for the art. So it's not non-fungible. The same is true for real estate. So I think it's important to separate all of those things. Okay. And so the one place I'll argue differently is Bitcoin is beta. It's not alpha. And by the way, I don't have any because I'm an idiot, because my original speech was it's for money launderers, criminals, and tax evaders, you know, and speculators, and it had no value. Well, I was wrong. It had one value and I just explained it. It has scarcity value that no other token has. Okay, there's 8,000, more than 8,000 ICOs, initial coin offerings out there. There's only one that stands above the rest. And to her point, Ethereum has a lot of use cases. It's not just a store value. Non-fungible tokens are garbage. They're just a scam. And people play with them in meme tokens and all this stuff. It's just a game. It's not investing.
As I mentioned, there's one decentralized, right? So the founders of Bitcoin, when they created it, it was after you've mentioned a lot, the 2008 crash. Six of probably this, I say six, I don't know how many there is, but six of the smartest people came together and said enough of government and bank control of money, right? Because as you saw, who lost at that time? All the people that had mortgages and lost their homes and the whole thing. And literally they created it to help the 2.5 billion unbanked financial inclusion, right? So people don't realize in America, because we have the US dollar, but millions of people around the world are using Bitcoin. It is safer than like all these like high inflation, like Zimbabwe, Nigeria, Venezuela. And so when I think about, when that whole thing about nefarious acts, because at the beginning, those were the people that kind of embraced it. But then all the governments and banks, all they wanted to do was put it down because it was the fear of what is going to happen to the US dollar, right? And the unknown. But so I think when we think about the difference, remember centralized means a few people control it, right? So when it's decentralized, the people control it. Millions of computers are verifying the data for Bitcoin.
So I want to ask you a question because I think you know something about this. So first of all, if JP Morgan's making it, it's because they can sell it. There's no philosophy. But the
Nobody
quick
asked me to
question.
wrap up this conversation, so let's do that real
Okay,
quick with your
quick
question to her.
quick question for her.
And then I'll take.
Putting Bitcoin aside, because I think this is very relevant, is I have seen, and you probably know more than me why I'm asking you, a lot of microfinance strategies in parts of the world where there really is no good banking system. And that's all decentralized. That's controlled by just networks of people. Have you been involved in any of those things?
Well, right. So we fund 100,000 microloans a year. We're partners.
There you
Yeah. So we're very involved in that space. I will tell you though, they have not crossed that line yet. So they're not actually, using Bitcoin. It's still the archaic system and so forth.
Bitcoin.
Not yet. But there's a lot of
I was
like,
asking about.
yeah, there's a lot of small companies now popping up and doing it. Yes.
Yeah, so Tyson, we're going to wrap up with you. You want to talk about your strategy around gold and how you're thinking about that commodity strategy that you have together?
Sure, I have a hedge fund SMA hybrid strategy that is focused around gold mining stocks. And that is because this sector, generally speaking, is very undervalued, but it's being driven by higher and higher gold prices. And while I'm not making any wild predictions about much higher gold prices, some very bright people are talking about much higher levels. And if that happens, that will be significantly impactful on the earnings. But to give you a sense, the GDX, which is an ETF of gold mining stocks, is down about 25% from 2011. And the GDXJ, which is the junior gold miner index, is down 60% from 2011, yet gold is up 80%. I think a lot of the problem has to do with ESG, environmental concerns, and regulation, really raising the cost of producing gold. But now with these higher prices, you have some gold companies that are now suddenly becoming profitable. And I think that the general global environment, the economic environment, the Trump agenda, all lend themselves to continued uncertainty. So you can buy gold, you can buy silver, and you can buy commodities. I think that makes a lot of sense. But there's particular demand in gold because central banks are buying it. I think that will continue. And I think that the prospect of it just gaining more momentum, being seen as more than just a safe haven, suggests that, 5 or even 5,000 or even higher levels is doable. And what that's doing to the earnings on a sector that has been out of favor for years now, that is now coming back. There's great potential there. We've had tremendous success with some micro caps in the space by investing in stocks that have been left for dead, that have gotten their mining licenses and are getting their funding and are about to start generating cash flows. And these things are below the radar screen. And in fact, we have
I'm getting the
several
hook here,
accounts.
so
Excuse
if
me?
you could wrap, I said, I'm getting the hook here, so you have to wrap.
So that's it. I mean, basically, we're up 400% on one position in the junior mining space, but we see one other that we're looking at, and the large cap opportunities. You can buy long-term call options, which historically are undervalued, and you can play some of the bigger names, leveraging off what I think is likely continued strength in the gold market and good momentum in the earnings.
I love panels where the speakers and panelists are very passionate about what they're investing in and what they're doing. I think we've seen a great demonstration of that from Rick, Andy, and Wendy here today. And Tyson, you came in a little bit late, but we welcomed you to the party. So thank everybody for doing that. It was absolutely terrific.
Thank you.